Hi, good afternoon, and welcome to the University of Toronto Mississauga's webinar, An Introduction to Socionomics. My name is Imre Gams, and as a UTM alumnus, I'm so pleased to welcome you today and look forward to what is sure to be a lively and enlightening discussion. Today, we have alumni and friends from all over the world watching this event, from India, Nigeria, Hong Kong, Australia, Scotland, Germany, Italy, Guyana, Singapore, Indonesia, the UK, the Netherlands, Colombia, Spain, and all across Canada and the United States. Welcome, everyone. Following this presentation, there will be a moderated question and answer period, and we encourage you to submit questions using the Q&A button at the bottom of your screen. However, please hold off on submitting your questions until after the initial presentation is finished, as your question may be addressed during that time. If you're having technical difficulties, please use the Q&A button and one of our staff will be there to assist you. Before we get started, I'd like to gauge our audience's familiarity with socionomics. You should see a poll pop up on your screen soon. Please choose the topic that most describes your experience with today's topic. All right, thanks so much for taking the time to tell us a little bit about yourselves. Most folks here have said that they're not all that familiar with socionomics, and that's fantastic because we're going to be covering this topic in depth, at least giving you a good introductory understanding to socionomics today. So without further ado, I'll get things started with some brief introductions. As I mentioned a moment ago, my name is Imre Gams. And socionomics is something that I use in my personal and professional life every single day. So for example, I use my understanding of social mood to time the purchase of my house. And when I anticipated gas prices going up, I made the switch to an electric vehicle. So I can't tell you how excited I am to help host this event on what is, in my opinion, one of the most important subjects you can study today. Professionally, I'm a serial entrepreneur, a venture capitalist, and I'm currently the managing director for Artemia LLC, an asset management firm based in the Cayman Islands. I'm happy to have served as a volunteer for the University of Toronto since 2018, and I'm currently a community member of U of T's Mississauga Campus Council, a member of the College of Electors, and a board director for U of T's Mississauga's Alumni Association. And I'm delighted to be sharing the floor today with today's guest speaker, the director of the Socionomics Institute, Matt Lampert. So Matt and the Socionomics Institute's research group use data on social moods to understand and anticipate developments in social trends. Matt's research has been supported by the National Academy of Sciences with funds from the National Science Foundation, and his work has been featured by USA Today, CNBC, the Associated Press, and other popular news and scholarly outlets. He also leads the Institute's Trendtelligence consultancy, which helps entrepreneurs use socionomic insights to improve their strategic decision-making. And thank you so much for being with us today, Matt.
Well, thank you, Imre. I'm excited to be here. This should be fun.
All right, we're all set to get started. I'm really excited for what we have in store today for our audience.
Me too, Imre, and I'm excited to see that we've got an audience of mostly folks who are going to be hearing about socionomics for the first time. This is just a treat to share this perspective with folks. And I thought perhaps we could begin the discussion by talking a little bit about what socionomics is and what it is not, because it is a new field. And so for that reason, I'll bring up some slides that we can look at. And we'll start with a question we get all the time in socionomics, which is, what is the difference between socionomics and socioeconomics? These are two words that sound a lot alike, but they have important differences in meaning. So perhaps we can start here. When we think about socioeconomics, what we're thinking about there is a field of study that looks at the relationship between really the intersection between economic variables and societal outcomes. So a socioeconomist might ask a research question like, how does obtaining a college degree influence expected lifetime earnings? Or how does growing up in poverty influence, say, average life expectancy? These are really important questions, but these are different from the kinds of questions that we're going to look at today. In socionomics, what we're looking at here is the relationship between trends in social psychology, what we call social mood, and social behavior, social actions. So a socionomist would ask a research question like, if social mood was becoming more positive and more optimistic, what does that say about, say, the prospects for world peace? Or if social mood's becoming more negative, more pessimistic, if people are becoming less confident, then what does that say about the odds of an economic recession? So in socionomics, we're really tying psychology to behavior, and we're doing it in a way that's a little bit counterintuitive for folks, Emery, as you know.
Yeah, indeed, and it's really my favorite. My favorite thing about the study of socionomics is how we're really flipping on its head the popular, I should say, conventional way that we approach the unfolding events of human civilization.
That's true, because when most people think about this relationship between social mood and social events or societal trends, what we tend to think is that these events impact our mood. So we read things in the newspaper like, oh, hey, there is GDP growth, the economy grew, so that's going to help consumer confidence. Or maybe if a world leader gives a rousing, encouraging address that might band the country together, things like this. Well, what we do in socionomics is we flip that on its head, like you said. And to really see that and appreciate it, I thought we could look at some headlines. These are the kinds of things that we read in the newspaper all the time. So we'll just look at a few of these. This top one on the left, Japan stocks fall, yen keeps funds in bearish mood. So what's the presumed cause and effect here? We've got falling stocks in Japan, something going on in the currency market with the yen, and the presumed result is that these events have created a bearish mood, a negative mood. We'll look at another one, US earnings, ASML, sour mood in Europe. So maybe some earnings reports came out in the US, perhaps they were not as strong as economists had expected, and the presumed result is that this is going to have a negative effect or a souring effect on mood in Europe, and on and on. And Emery, these are examples of an idea that says that economic events, financial events, political events, or in short, social events influence the tenor and character of social mood. This is precisely the sentiment we tend to see in the popular press. It's also precisely the sentiment we tend to see in the academic press when the subject is broached. And in our view, it's precisely backwards, because these events have to come from somewhere, and they come from people who have feelings. And so if you know how people are feeling, then you have a leg up on understanding, and in some cases, even anticipating the kinds of things that they're going to do. So in socionomics, we say, no, it's the other way around. The psychology comes first. It's social mood that influences the tenor and character of social events. That arrow of causality goes from mood to behavior without a feedback loop.
Now, what's interesting, Matt, is whenever we talk about feelings, there's a sense that there's a qualitative that feelings are qualitative in nature. We can't really measure feelings. What would you say to that?
So this gets to the heart of the empirical research program in socionomics. So how do we measure social mood? How do we identify what the social mood is? And there's a number of ways that we measure it. We can look at mood through a number of different prisms, so to speak. And one way to measure social mood is, say, by surveys. You could go out, you could ask people, hey, how optimistic are you today on a scale of 1 to 10, this sort of thing. And some people do that. They look at surveys, they look at macroeconomic variables, they might look at something like consumer confidence. But we find that the best way, the most reliable way to measure social mood is to use the stock market. And that may seem like an unusual choice, but I'll make an argument in favor of why it's such a good sociometer or a good indicator of social mood. And that is, one, people have been expressing their waves of optimism and pessimism, their feelings of fear and confidence in the stock market for generations. We have the data going back hundreds of years in some countries, so we have a way to go and back test the theory. Not only that, people can express their change in mood quite quickly in the market. If I'm feeling more confident or more optimistic, say, I can go and trade a stock and it I'll be done in 30 seconds. It just takes a few clicks of the mouse, maybe a call to a broker. Whereas someone else who's feeling that confidence, they're feeling that optimism at exactly the same time, why they might express it in a different way. Let's say they go out and open a business. Well, it's going to take them a lot longer than 30 seconds to do that. They're going to have to come up with a product or service, maybe get a business license, hire some staff, maybe find a location to rent. And by the time they execute all of those decisions and that business is up and running and say contributing to a data series like economic growth, well, it might be months or even a year after that moment when they initially made that decision to start that process. And that's one reason, in our view, why the stock market is such a strong macroeconomic indicator, is because these changes in social psychology can show up first in the market, or at least relatively quickly in the stock market. And then we can use trends in the market as a basis to forecast changes in a number of other areas of human social behavior where those decisions take longer to execute. And we'll look at some examples today. And Emery, if we could pivot back just to one point here on the screen to make this point about causality and how a socionomist looks at social causality so differently than everybody else, just so the audience gets in the game here and gets some practice. Let's take a look at something like a recession. Well, the conventional way of thinking about a recession is that a recession causes business people to be cautious. But a socionomist says, well, where did this recession come from in the first place? Did it not come from cautious business people behaving cautiously? And that's what generates the recession. So the psychology is primary, it motivates the action, and then the social event, in this case, a recession, is just a result of that. We won't go through every single one, just a handful of others. You might think talented leaders make the population happy. That seems like a conventional idea. Socionomics says it's really the other way around. When society is feeling more confident, more optimistic, more productive, then they engage in trends that make it appear as though these leaders are doing great work, but really the psychology is primary. And we'll actually look at some examples of that later in the presentation. To pivot back to the markets, conventional view would say a rising stock market makes people optimistic. The socionomist says, why did the market rise in the first place? It's in fact increasingly optimistic people that make the stock market rise, and on and on and on. And when we talk about measurement, again, what we're going to see throughout this presentation is using the stock market as our meter of social mood, what we call our sociometer, and using it as a basis to anticipate some important trends and developments. But maybe, Emery, before we do that, we could really take on this conventional view in a significant way, because a conventional analyst might say, well, come on, Matt, surely if something like a major terrorist attack happened, it would impact the social mood and have some meaningful effect on the stock market. So should we look at an example of probably the most famous one of all of the past quarter century or so, the 9/11 attacks? Now, we just had an anniversary of the attack. This is a chart of the stock market around the time that this tremendously important and momentous event occurred. And if you know the stock market, maybe you happen to recall where it happened, but if you didn't, and you look at this chart, is it self-evident where this significant event materialized? You might think, well, maybe it was near one of these relative peaks and it sent the stock market lower thereafter. Shall we see where the event occurred?
Yeah, let's take a look. I always love looking at this exact chart. It's fascinating.
Okay, so let's see where this significant event occurred. Well, it occurred here. And let's take a look at what was going on at the time. The stock market peaked in early 2000. And so by September 11th, 2001, it had been going net down for more than a year and a half. And people might remember after the attack, the market did continue down. It continued down for a grand total of 5 days, and then had the biggest rally since the top back in 2000. And so a socionomist would look at this event quite differently. A conventional analyst would say, oh, this is a wild card event that happened and it just changed the trajectory of the market. A socionomist says, well, the attack itself is a significant manifestation of this larger degree trend toward negative social mood. It's inclining conflict, pessimism, anger, anxiety. And we do tend to see significant outbreaks of terrorist attacks in these negative social mood environments. In fact, my colleague Mark Alashevsky's done some really good work there, looking at some social mood indicators in the Middle East to try to understand these trends as well. But anyone who was using this attack to time the market from a conventional angle really got blindsided by this huge surge up. And I'm pleased to say that the leading socionomist, Robert Prechter, at the time issued a report the night of the attack saying, this is a sign that this trend toward negative mood, at least in the short term, is probably closer to an end than a beginning, and to start looking for a move in the other direction, which ended up unfolding. Yeah, so you can start to see these events through a totally different lens. Now, one thing I do want to hit really quickly is that when we talk about feelings, let's be precise about what we're talking about. There's an important distinction between mood and emotion. So what we're talking about in socionomics is mood. Now, emotion is different. Emotion is a feeling state that's a response to a stimulus. So of course, when something like this event happens, you might be scared, you might feel fearful, this kind of thing, in response to that event. So emotions are consciously experienced responses to an external stimulus. They tend to be fairly fleeting, and we're aware of them. So in other words, you feel a certain way, you feel a certain way, and you know why you feel a certain way. Mood, what we're talking about in socionomics, is different. It's more diffuse, it's longer lasting, it does not have this external stimulus or this external referent. And there's some really interesting neurological research that suggests that it's processed in the unconscious part of the brain, meaning that while you might have a general feeling, you may not know why. And to the extent that you do know why, you're very likely to misattribute the source. So you might say, oh, I feel bad because of this thing a coworker said. But if you were feeling a little bit more positive, maybe that comment you would have been able to handle it differently, that kind of thing. So I just want to be clear about this distinction. So at socionomics, we're looking at these longer term trends in social mood. And this idea of our feelings impacting financial pricing is an idea that people in behavioral finance have begun to catch up with. Not quite enough. We'd love to see them go even further, but at least in the behavioral school of financial markets, it is becoming more and more accepted that our feelings impact our financial decision making. When people are feeling more confident, more optimistic, they tend to be more likely, research shows, to take on financial risks, whereas if they're feeling less confident, they tend to do less of that, and so on. Is a really interesting line of inquiry there. And this is a huge improvement, in our view, over the traditional view of financial markets, which comes from this idea called the efficient market hypothesis, which is the idea that markets simply rationally reflect available information. And the behavioral school says, well, okay, that's fine as far as it goes, but people also have emotions, they have feelings, they have moods. And this non-rational component, the psychological component to markets, is really important to understanding financial market pricing. So where does socionomics fit into all of this? Well, socionomics says behavioral finance is great, it's moving in the right direction, but it's not really another pole. It's not the polar opposite of the efficient market hypothesis. Behavioral finance is a middle ground theory, because the opposite of the idea that financial market pricing in the aggregate is due to a rational reflection of information. Well, the opposite of that is not a mix. The opposite of that is that financial market pricing in the aggregate is regulated by these trends in what we call non-rational social mood. And so we look at the psychology as being just an absolutely essential motivator of these trends in financial market pricing. And we think it's different in economic markets, and we can talk a little bit about that, but certainly markets for speculative assets, financial assets, stocks, that kind of thing. Really think that psychology is in charge. And by the way, there's been Nobel Prizes won by folks who have worked in the efficient market school. There's been Nobel Prizes won in economics by folks who work in behavioral finance. So if you're someone out there who's looking for an opportunity, hey, where's this trend going next? There could be an opportunity to dig into the socionomic theory of finance and do some pretty cool research. And perhaps we can take a look at some of that research next.
Yeah, just to speak to the importance of non-rational approach to financial asset pricing. We talked about this before, Matt. My favorite example here has to do with the idea of shoes being priced a certain way, and then a financial market like stocks or even Bitcoin being priced another way. And I love this example so much. What we don't have with more utilitarian goods is this fear of missing out, which is very much present with financial assets. So, if you saw that Bitcoin was crashing and crashing and crashing, and you didn't own any, you'd probably think, oh, well, I dodged a bullet. People told me to buy it and I didn't. And look, it's going into the ground. I'm so glad I don't own any. But on the other hand, when Bitcoin is doing really, really well, or if a particular stock is doing really, really well, and all you hear are people talking about how it's going higher and higher and higher, you have this real sense of anxiety that you're not on board, that you're missing out on this amazing party. And so you buy these assets, and from personal experience, what I've seen is more often than not, when you make such a decision, you're buying the very top of a particular market. However, when it comes to something more utilitarian, where we can activate those rational parts of our brains, for example, like a pair of shoes. If you walked into your shoe store and the shoes were, they were half off, you wouldn't hesitate. You would say, that's a great deal. I needed to buy shoes, and the fact that they're 50% of whatever they're normally priced at sounds like a good deal to me. But on the other hand, if the salesperson told you, hey, these shoes are going to go up in price by $50, in 10 minutes from now, you gotta act quick. And after that 10 minutes, they're going to go up in price. They're going to double in price after that. So you better hop on these shoes. You would call the salesperson crazy, and you would say, there's no way. I know what these shoes are worth. I know what they're priced at, because that's the price they've been at for the last 2 years, 3 years, whatever. I'm going to wait for them to go on sale. And there's just this very different approach to how we understand pricing for two different kinds of markets. And I've always found that fascinating, especially as we're moving, more towards the importance of how psychology plays into the pricing of these assets.
Sure. So it's something like the market for shoes. The personal value that your money has to you, and the opportunity cost of spending that on shoes versus something else. And how much value you're going to get out of those shoes, or at least a fairly reasonable estimate. Okay, I'm probably going to wear them for so many months or years, and I like the way they look. So your own personal values, your own personal preferences, and so you can rationally apply a cost benefit analysis and make sense of whether that purchase makes sense. In financial markets, it's totally different. You have no idea what the market's going to do tomorrow or next year or in the next minute. And so you're in this world of tremendous uncertainty, and you lose all of those bedrock benchmarks that you can use to evaluate what would be a reasonable thing to do. You're trying to evaluate what the group believes the group will believe an asset is worth at some point in the future. And in this environment of uncertainty, it creates all the wiggle room in the world for herding and these non-rational instincts to take over. And we see that time and again, and we'll look at a specific example of that when we talk about housing and real estate a little later on. But for now, let's talk about something completely different. Let's talk about an empirical application of this idea that we can use the financial markets as a meter of social mood, and use that meter of social mood to understand social trends. And we'll look at a particular example, the trend of war, or the development of war. So this is a chart of stock prices going back more than 300 years. If you've ever wanted to know what 300 years of data on anything look like, well, here's an example. This is a 300 plus year history of stock price data. We've started with British stock prices on the left, and then we've spliced on US data. They're around 1776. Just give us a data series. And what we're using this for, though, is as a benchmark of social mood. And so you can imagine social mood becoming more positive, as indicated by rising market, not because the market's causing anything, it's just people are becoming more optimistic. And one way they express that is by bidding up stock prices. So we see mood becoming more positive, and then we see this correction where mood becomes more negative, and then mood becomes more positive yet again, and more negative, and so on. So if we think about conflict, if we think about war, would you expect societies to be more inclined toward conflict, more inclined toward war, when they were feeling happy, joyous, confident, and optimistic, or when they were feeling anxious, fearful, and depressed? Probably the latter, right? Probably going to be more inclined toward fighting when they're in that negative mood. So we would expect to see significant outbreaks of war clustering at these negative mood extremes reflected by these downtrends in the market. And we'd expect periods of relative peace to be associated with the periods around the peaks in our trend and social mood. So let's take a look at what we see when we look at the data. Well, we see that these wars have indeed tended to cluster near these negative extremes in social mood, with these periods of peace, relative peace, of course, coming near the tops. And then again, near these bottoms, we see significant manifestations of negative social mood. And Emory, scholars have been trying to understand why it is that societies go through these phases of war and peace and war throughout the generations. Well, here, just with a few minutes of knowing about socionomics and a long-term graph of stock prices, we were able to come up with a hypothesis that explains 3 centuries of war and conflict in a fairly elegant manner. That's pretty cool.
It is indeed. I apologize if any noise is coming through, by the way. I just had some landscapers show up unexpectedly. But yeah, what I love about this chart in particular, Matt, is that you're right. It's a very elegant representation of data, because a very common question that I'm sure the both of us get quite often is, what sources of data do you look at in order to come to some of these determinations? And more often than not, my answer is I look at these kind of charts, these stock market charts, and the patterns that we see here are repeatable, and that makes them predictable, and that means we can forecast using probabilities what is going to be happening sometime in the future. No, we don't know exactly what is going to happen, and down to the minute details, but these patterns where we can trace extremes and identify major turning points is a very, very elegant solution to some of the biggest questions that academics and business people, politicians are asking themselves each and every single day.
Terrific. So we've looked at this example, a big picture trend looking at war. Let's look at a thought experiment here, because you just alluded to this point that we can address all kinds of research questions using this framework. And so what I would invite you to do in the audience to do is just imagine a society, and imagine that society when it's in a positive mood, and then imagine that society in a negative mood. And just think about things like, which of these 2 societies would you expect to be more economically productive? The folks who are feeling optimistic and excited, or the folks who are feeling a little downtrodden and down in the dumps? Probably the happier, more excited crowd, right? Which of these 2 crowds would you expect to be into maybe some more aggressive music with more pessimistic lyrical themes, some harder edge sounds, this kind of thing? Probably the latter group, right? Probably this group in a negative mood. And so just by doing this thought experiment, you can generate a number of applications and research questions that you can address using the socionomic perspective. And we just mentioned the example of music, which might sound frivolous, but it's an important part of a lot of people's lives, and it's crucial if you're in the music business. So you think about what business you're in, what's your industry, what's your career path, and how might these trends in social psychology reflect or influence, I should say, what goes on in your world. So let's take a look at this example of music just in more detail to show one industrial application or one commercial application of this idea. So this is a chart of stock prices, and the founder of socionomic theory, Robert Prechter, first published a version of this chart in 1985. The particular version we'll look at today is from an update that we put out in October of 2009. But we'll look at a chart of stock prices. So we see here in the 1950s, a rise in the market. So this is one manifestation of positive social mood becoming more confident, more upbeat. Well, traders were feeling more confident, more upbeat, and teenagers were feeling more confident and more upbeat as well. And so they were choosing to listen to, this is the birth of rock and roll, an upbeat, energetic, fun style of music. As this market top took place, during these topping phases, we tend to see significant positive and negative mood manifestations start to come to the fore at the same time. And we saw that with the rise of bubblegum, but also a falling transition toward more aggressive sounds in rock and roll. You had the advent of psychedelic rock, hard rock, heavy metal, and then as this bear market unfolds, this trend toward negative social mood, gosh, by the end of this, you had punk rock. And then as the trend turned toward the positive in the 1980s, during this bull market of the 1980s, it was the rise of pop music again, with idols like Michael Jackson, Madonna, Cyndi Lauper, grunge music. There's a very narrow window of opportunity for something like that. In the early 1990s, a recession, a little setback in the market. That's when Nirvana, Pearl Jam, Soundgarden, these more harder edge, kind of hard rock influenced, classic rock influenced, punk influenced bands had a small window of opportunity to come to the fore. But as the bull market of the 1990s blasted off, these bands by certainly the mid 90s, by the late 90s, had mostly fallen by the wayside. The records weren't selling as briskly as they once did. And it was another era of pop icons: Britney Spears, the Backstreet Boys, NSYNC, and on and on. So this is an application of socionomics that we've traced, literally going back more than 30 years. But you might be saying, well, hold on, isn't this just sort of a theoretical representation? How do we really know that these trends are reflected in music? Well, we're thrilled to say that some empirical researchers have come along in recent years and tested these ideas, including one paper that came out in 2018, which used some algorithmic tools to assess songs that charted on the US and British stock charts, and found a remarkable relationship between the sentiment in those songs, particularly the lyrics, and the trends in consumer confidence and the stock market in both the US and the UK. This was a paper that came out the same year, which applied these ideas to pop music in Finland, which I thought was such a great example, because if there was one country whose pop music I knew absolutely nothing about, it would probably be the pop music in Finland. And yet in this comparative analysis between pop music in Finland in 2006 and 2009, a period of positive mood and a period of negative mood, they found, yeah, the pop music was poppier when the mood was more upbeat. And then this is a paper that just came out just a few weeks ago. It came out in the Journal of Financial Economics, where some researchers use some tools from Spotify to measure the sentiment of popular music in 40 countries, the most listened to songs across 40 countries, and found a remarkable relationship between the sentiment, what they call the valence of that pop music as they quantified it, and the stock indexes in these countries. So it's a remarkable relationship. It's just intellectually interesting. But if you're in the music business, imagine the value of knowing when to pivot toward harder edge sounds, more aggressive bands. If you run a record label, you might have some groups that, hey, the records aren't selling, should I drop them? Well, you might want to hang on to them, because this is an important element to have in your music portfolio, so to speak, when mood becomes more negative. And likewise, if you're in a negative mood trend, when mood becomes more positive, what bands do we want to release? What artists do we want to promote? It has a remarkable industrial value here. All right, Emery, we've got to pivot back. We had too much fun with music. Let's get back into some more serious territory. And this is a topic that's, of course, been very important to just about all of us over the past year and a half or so. And that is trends toward epidemic disease. If we think back to the conventional way of thinking, if we take our socionomics hat off for a moment, the conventional view you might think, well, an epidemic would make a society fearful, depressed. It's going to cause all kinds of chaos in the financial markets. Whereas the socionomic view, again, flips things around and says, well, the epidemic has to come from somewhere. And there's some interesting research about the relationship between people's psychological constitutions, their levels of optimism and pessimism, and their susceptibility to major outbreaks of disease. And it turns out that if you look at this, look at the history of epidemics plotted against stock charts, you see something fascinating. And we've looked at this for a number of years. In fact, the very first issue of our monthly research review, The Socionomist, looked at the history of social mood, stock market performance, and epidemic disease. We've followed that up with several updates over the years, including an academic paper. Can't get into all of that research today, but I just want to give you a fly through so you see how this works in practice. So what we do is we simply look at the trend in social mood as reflected by the stock index of the country where the epidemic originated, where it broke out. So we'll look at this going all the way back to the cholera epidemics in the 1800s in Britain. So this is a chart of British stock prices. And what you see is that all of these cholera epidemics unfolded during what was a more than 60-year bear market. This is a 60-year trend toward negative social mood. People these days get worried if the market goes down for a couple of months. Imagine 60 years of, or 50 years, I should say, of negative social mood. I mean, a half century. It's remarkable. And you see, not only did we get significant outbreaks of epidemic disease, but the outbreaks tended to cluster near these lows, near these local minima in the index. These what we call negative mood extremes tend to be associated with the greatest periods of susceptibility. Now, it doesn't mean that every low has an epidemic. It doesn't mean that epidemics only come out at lows, but it does mean that if you can identify that you're in a large degree negative mood trend and approaching a negative extreme, it's a time to be especially vigilant for something like a significant epidemic disease breakout. And just to pivot back toward this conventional view, the conventional view, people are going to be very confused because you see these outbreaks occurring and then it looks like, gosh, after every outbreak, the market just jumps higher with an interim rally. Maybe a conventional person might think, oh, maybe we've just got it backwards. Maybe the idea is that the epidemic is actually good for the stock market. Well, that has some perverse conclusions if you carry that too far. But fortunately with socionomics, you don't have to reach those conclusions. Because again, we're not saying that the market's causing the epidemic. We're not saying the epidemic's causing the market. We're saying that these trends in psychology are showing up in both of these domains simultaneously. That negative mood is showing up both in this trend toward a bear market, and it's showing up with a heightened susceptibility to epidemic disease. And we'll just look at several examples. We went into that one in detail, so we'll just look at these others really quickly just so you can see the similar pattern emerging. There's a 20-year negative mood trend from 1900 to 1921, and toward the end of that trend, last few years, there was a significant eruption of outbreaks. There was polio, there's encephalitis lethargica, and then the most famous is the Spanish flu epidemic in 1918. And interestingly, Spanish flu killed even more people than another significant negative mood expression during this negative mood trend, World War I, another area where that psychology is manifest. After another 20-year negative mood trend, 20-year bear market in 1949, had an outbreak of polio, significant polio epidemic. And then the AIDS epidemic emerged at the end of a 16-year negative mood trend, as reflected by the Dow PPI. And we can do this all day. We've got the Hong Kong flu. This is a chart of stock prices in Hong Kong, emerged near a significant low. Avian flu, some folks might remember. And then SARS. These epidemics were not as significant as some of the others we've looked at, and you'll see that the downtrend in stock prices was not as significant as well. Nipah virus in the late 1990s erupted in Malaysia, and folks said, well, hold on, was the late 1990s a pretty positive time? Not in Malaysia. The Asian financial crisis in the late 1990s was significant. We saw the outbreak of an epidemic there. And then swine flu, you might remember from 2009. We're looking at Mexico here, Mexico's stock chart, because epidemiologists seem to think that the outbreak emerged in Mexico. So again, we want to look at the country of origin, but you might remember the 2009 was a year of a global financial crisis. We had significant negative mood all over the world and a significant pandemic. So what about Brazil? Zika, another recent epidemic, same story. And now we get to the star of the show, so to speak, the COVID-19 epidemic. That's probably the worst phrasing I could have used to describe COVID-19, but it's already done. So here we go. COVID emerged after a dozen years of a net decline in stock prices in China. We have the Shanghai composite on the chart here, and we've got some other significant epidemics that impacted China on the chart as well. But just to show that it's a similar story, we had this long-term negative mood trend in the country of origin in China, and toward the end of that trend, or at least as that trend was maturing, it was becoming quite mature. The time was right socionomically. At least there's this vulnerability for a major epidemic to erupt, and that is in fact what happened. And again, we always want to look at the country of origin, but we thought it was just interesting, also in the US, that the stock market peaked prior to this significant acceleration in new COVID-19 cases. And you might say, well, there wasn't a whole lot of testing at the beginning. Yes, that's true. But even as the testing came online, it's indisputable that the initial wave was just skyrocketing higher in new COVID cases as the market was likewise going higher. And a socionomist says this makes perfect sense. You've got the trend in negative mood showing up first in the stock market, this trend toward more negative psychology. And then we have this epidemic erupting stateside as this trend is becoming quite mature. And this trend in the market going higher is just the stock market again being a leading indicator. And so people shared this image on Twitter saying, what's going on here? We got the best week in Dow history since 1938. We have all these job losses going on. What's going on? Well, to a socionomist, what this is saying, this market rally is telling you that all of this economic data that we were seeing at the time was going to improve. And that improving sentiment showed up first in the stock market, and then it showed up later in broader macroeconomic trends, but of course we went through a significant amount of turmoil in the economy in between. All right, take a deep breath. We're going to have some more fun. All right, let's take a look at another commercial application. And Imre, you can help me on time here. If we need to fly through some stuff, we certainly can. But just real quick, if you think about trends toward positive mood, what we found is that one way that those psychological trends manifest is in people's car preferences. When mood's positive, people generally, they want to go faster, cars that have more horsepower, bigger engines, in some cases, bigger cars themselves, like the SUVs that filled the driveways in the 1990s or in more recent years, or with respect to the need for speed, the muscle cars and sports cars of the mid 60s. Whereas when mood's negative, people have different priorities. Negative mood is all about just give me something that gets me to point A to point B. I don't really care that much about horsepower or speed or any of that stuff. We tend to see more rounded designs. And just to show you one wild manifestation of this is a chart of stock prices. In the US, we got the Dow PPI. And you might think that this other indicator was just like a financial indicator, maybe a sector or some sort of economic variable like GDP. Well, it's actually the maximum net horsepower in the Corvette for each model year over the same period of time. And you see as mood was becoming more positive, that more positive mood manifested as a rising stock prices, more optimistic traders, but also a greater need for speed or a demand for speed among car consumers. As this trend reversed course in psychology, it also reversed course in the demand for horsepower. And in fact, there was so little demand that in 1983, Chevy didn't even bother to produce a Corvette. They said, why bother? Well, this is right after the low in a 16-year trend toward negative mood. And then as that mood became more positive, the horsepower caught up and became higher as well. All right, I suppose we should talk about real estate. Seems to be an important market these days. Now, if you're someone, maybe you're a prospective first-time home buyer, maybe you've been renting and you just have this dream of someday owning a home, just to have a roof over your head. And you look at real estate prices and you say, my goodness, they just keep going up and up and up. Will I ever be able to afford my own house? Well, this is where this distinction between economic markets and financial markets becomes so important. We talked about the difference between, say, shoes and stocks. But what's interesting in the housing market is that it's a market that can be both, not at the same time though. And I'll explain what I mean. If the housing market, if the participants in the housing market have a psychological orientation towards shelter, you just want to buy a roof over your head, a nice place to live, a nice place to stay, that's one thing. But if the market's dominated by investors, people who view that market as a market for speculative assets, they want to buy real estate not to live in and consume, but they want to buy real estate because they think the prices are going to go up. They want to make money. They want to have the rental income. Their orientation is totally different from what your orientation is in that market. For these folks who treat housing as a real estate market, if that's their psychological orientation, then if house prices were to go down, that's bad news for them. But if your orientation is towards shelter, that's the time when you want to jump in and buy. And so if you look at the housing market, not just now, but over the past decades, it's clearly a market that's been dominated by real estate, a real estate orientation, a financial orientation. And we see that to a significant degree now. If it's not just folks buying one or two houses for investment properties. We have Wall Street banks that are getting in on the act, buying up whole neighborhoods. And this is just one representative headline saying Wall Street's buying up family homes. The rent checks are just too juicy to ignore. That's their rationalization. That's why they think they're doing it. Are they really doing it though because these rent checks are too good to be true? Well, let's take a look at the ratio of home prices to rents going back 50 years. And as you can see, they've never been higher than they are now. In other words, it's never been more expensive to generate $1 of rental income in the real estate market than it is today, at least over the past half century. So what we think is going on is folks in this market, particularly the Wall Street firms who are jumping on masse, are hurting. They're just joining this psychological trend. And what we see in financial markets is that the conviction among market participants that that trend is going to continue in the same direction tends to coalesce and increase and intensify, such that at the major extremes in trend, meaning at local heights or local bottoms, people are the most convinced that the trend is going to continue in that direction. In other words, they're the most convinced, they're the most confident at the worst possible time. And so there's a way to circumvent this, or at least to potentially circumvent this. And that is, in socionomics, we think that not only is mood and psychology important to regulating these trends, we have some really interesting evidence that the trends in social mood themselves are patterned according to the Elliott wave model. Now, we don't have time to get into this model today, but I just want you to know that there is another way of thinking about financial market pricing and forecasting that allows for not only anticipating continuations of trends, but also their reversal in real time. And if you're interested in this financial market forecasting component, then I invite you to go to elliottwave.com. That's Elliott Wave, 2 L's, 2 T's, wave like ocean wave.com, where you could learn more about using this perspective to anticipate trends in the financial markets. Emery, I'll let you be the judge on whether we should keep going, take some questions. What do you think?
We have a little bit of time. I think we can pivot to our last important section, which is of course in the political arena, and then after that we can move to some questions.
Okay, sure. Yeah, let's do this. So a book we came out with a few years ago called Socionomic Causality in Politics is filled with applications of this view toward understanding political trends. We're not saying, right versus wrong. It's not a normative kind of thing. It's really just understanding timing, why certain political trends and political topics and themes and causes tend to come to the fore when they do. And one area where we've looked at in a significant amount of detail is in the area of elections. And in 2012, we released a paper that looked at stock market performance preceding every election in US history, going all the way back to George Washington. No one had done this before, and we were really interested to do this study. And what we found was that we found a couple of things that are really interesting. One is that the trend in the stock market in the 3 years leading up to a US presidential re-election bid is a stronger election indicator than GDP, inflation, and unemployment combined. In other words, this trend towards social mood in the market is better at anticipating which way an election will go than these other macroeconomic indicators. The other thing we found, which is subtle but important, is that in elections where there's no incumbent candidate, no sitting president running for another term, the association between the trend of the stock market and the outcome of the election basically goes to zero. And we think what's going on is that in the human brain, we are reflecting our mood on the leader. And this part of the brain is fairly primitive. And so when there's no specific leader running for another term, perhaps people base their choices on other factors. But when there is a leader running for re-election, we find this trend of the market is a really powerful indicator. And we dug back into this work last year in 2020 because we had an election in the US, and we found something interesting, an interesting nuance. And that is, in elections where the stock market had gained 3 years, when the stock market had gained at least 20% in the 3 years leading up to an election, incumbents were reelected 87.5% of the time. So an overwhelming percentage of the time, the incumbents won another term. But when the market gained, but did not gain at least 20%, it essentially became a coin flip. And it's about 50-50. At that point, we had 5 wins, 4 losses. And if the market lost any more than 5%, then 80% of the incumbents were ousted. So basically, market up more than 20%, pretty good chance to win another term. If it's up, but not quite that much, flip a coin. And if it's down, you might want to have a second career path lined up if you're that politician running for office. And so uh, when we looked back at the history of the market and elections, we saw this time and time again. So just look at a couple classic examples. In the Great Depression, Herbert Hoover was ousted in a landslide in 1932, and his replacement, Franklin Roosevelt, rode a tremendous wave toward more positive social mood and was reelected several times. And another slightly different manifestation, but an important one, is that the American Revolution, where King George was ousted from power from the colonies itself, came at the end of a 60-year trend toward negative social mood. So when we applied this to the 2020 election, we were watching the stock market, and just leading up to the election, the market ended up having its worst pre-election week in the history of the Dow Jones Industrial Average, and it brought the market into that coin flip territory zone where it had gained a net gain of less than 20%. And so we said, folks, this election is a coin flip. You're seeing polls that are saying one thing, but we think this election is going to be potentially much closer, even more controversial than a lot of folks seem to anticipate. And when we woke up the morning after the election, it was still a coin flip and remained a coin flip for a few days thereafter. And as we were waiting and waiting, all of these articles started to come out about, oh, there's just a catastrophe in the polling industry, what went wrong. And we thought, you know what, we were able to see this coming without polling a single person. That's pretty cool. And that's just one example, another example of the power of this insight. And I know we've got an election coming up in Canada. Emery, what can you tell us?
All right. So what I have found, kind of replicating your stock market and election analysis to the Canadian market and Canadian elections holds, for the most part, very true as well, where if the stock market tends to do well, then the incumbent government will retain power. Now, there are some interesting exceptions to this. For example, the Liberal Party defeated the incumbent Progressive Conservatives, the PCs, in '93. This is despite a rising stock market. Okay, so the PCs retained their majority in '88, and despite a rising stock market, they lost the election to the Liberals in '93. However, I'd say the closest stock market proxy for what we're seeing as we head into an election in Canada in less than a week's time is what happened in 2008 when the PCs retained a minority government, but then they won a majority government in 2011. So what we can see here between 2008 and 2011 is that, as we know, we had a financial crisis and the stock market took a deep plunge, right? So we're looking at an S&P TSX composite index here. So we took a big plunge in 2008, bottomed out in 2009, and then the PCs won a majority government in 2011. So from a social mood perspective, we can say that as the stock market advanced and actually exceeded the point when the PCs retained a minority in '08, people were feeling happy and confident, and they were not ready for a change in government. They didn't want to toss out the bums quite yet. And then what happened in 2015, the stock market declined, and it was below where the PCs won the majority in 2011, and we saw a new Liberal majority get elected. So I think this election coming up in September of 2021 is the closest proxy to what happened in '08, between '08 and 2011. We saw a significant stock market decline last year that a lot of people are attributing, as kind of the COVID flash crash. And then we had a melt up in one of the most impressive bull market runs, certainly the most impressive I've seen in my career since then. So what's going to happen? Well, history here would tell us, regardless of what the polls say, that the Liberals are likely to retain power. Now, whether, in Canada, we have a slightly different system where we can have a minority government or a majority government, whereas, in the US presidential election, it's kind of a winner takes all situation. My opinion here, and this is based purely on the data, is that the Liberals are more likely than not to actually win a majority government. Now, that might seem counterintuitive to any Canadians here, especially if you've been following the polling over the last few weeks, which has actually shown the PC party taking a slight lead, I believe. I haven't paid attention to the polls in the last couple of days, but my understanding is that the Liberals have narrowed that gap in polling a little bit. So it'll be interesting to see, what ultimately happens on election day. But this research into elections and stock market performance completely tracks with our understanding of how socionomics actually functions and works.
Interesting. Well, we'll tune in and see what happens. They're in the election coming up. Imre, thank you so much. Shall we wind things down and maybe take some questions?
Yeah, I think that's a great idea.
Okay, great. Great. Well, I'll just fast forward through some of these slides, and who knows, sometimes in the Q&A people will ask something where the slides that we didn't get to become an important part of the answer to the question. So we might pivot back and take a look at some of those. But just to sum up, we've looked at a handful of examples today of how you can apply socionomics, this understanding of social mood, to understand history, understand the present, and every now and again even anticipate some important changes in the social world. And if you're wondering, well, what else can we apply this to? The answer is a ton of things. We've got 5 books on the subject. We've published a monthly research review for more than 10 years. This is the cover of some of those. So there's a number of different fields where you can apply this. And if you'd like to learn more about the field, particularly if you want to dig in on the academic side and see some of our papers, or if you just want to see some more video material about socionomics and its application, and we'll also put the slides from the presentation at this URL as well. I would invite you to visit socionomics.net/papers, where you can check all of that out at your leisure. Imre, thanks so much for this conversation. I've enjoyed it very much.
Yeah, thank you so much, Matt, for sharing your insights and your experience with us. We do have quite a few questions that have come in from the audience, so let's just get right to it. We had this great live question come in, and it is, what are the commonly used data sources for socionomic researchers? The social media news headlines seem rather noisy and biased to capture social moods with granularity or precision. Example, political leanings, agendas. Are there any canonical studies or data sets available for socionomic researchers?
Terrific. Well, we've looked at so many examples of using stock market indexes. And one of the wonderful things about the stock market index is that the data are generally quite available. You can find at least the last 10, 20, 30 years of data for a number of countries online for free. Just do some Googling there and check that out. As far as other ways of getting at this problem of measuring social mood, we mentioned surveys, we mentioned consumer confidence, we mentioned macroeconomic data. The problem with all of those is that they tend to be slower than the market. And so you end up spending more in terms of the effort it takes to acquire and update those data series, while getting less in terms of precision of these changes in social mood. And the questioner asked about social media data. That is true. Some people do use sentiment from social media, text analytics, to assess social media sentiment as an indicator of social mood. The questioner is absolutely right. Those do tend to have a significant amount of noise. And there's some research being done by a couple of groups in particular where they're trying to get around that problem. And I'm really excited. I'm bullish on that area of research. And I think eventually it's going to come into its own and become a really powerful indicator. But for now, we find these stock market indexes are the most reliable.
So could you speak to the limitations of the stock market as an index of social mood? For example, if the people who invest in the stock market don't represent society as a whole, and this is an excellent point from this question, not everyone owns stocks. So then how can the stock market represent the mood of society as a whole?
Sure. So there's a tremendous amount of differences among people who own stock. There's a lot of differences in that group, and the population of investors is different from the general population with respect to a number of demographic characteristics. This is true. One of the things we did in our election study is that, remember, we're going all the way back to George Washington. So we're going back to a period where literally the percentage of households that own stock in the United States rounded to zero. I mean, there's a tiny, tiny amount of people who are trading stocks, and demographically, economically, financially, they were quite different, from the traits you see in the general population. And so what we did is we wanted to see if that was a problem. And so we cut the data in 1900. So in the 1800s, late 1700s, most Americans lived in rural environments. These are farmers. These are, you wouldn't even know what the stock market was doing for a typical American. Whereas, of course, in the 20th century and thereon, the stock market information was much more widely disseminated, much more stock market participation. And so was it the case that the market was a better indicator when a lot of people owned stock and a relatively worse indicator when hardly anyone owned stock? And we were delighted to see that what happened was that the predictive efficacy was almost identical. In fact, it was like the slightest bit stronger, not statistically significant, but the slightest bit stronger in the earlier period where almost no one owned stock. So what we think is going on here is that what we're looking at are these trends in social psychology, which run quite deep in a society. And the question is there an indicator that is good enough empirically that allows us to use it to make decisions and to understand the social world? And we find that the stock market is that indicator, but there's definitely limitations to it. For example, if I want to know what mood is like among a particular demographic group, say, to see if that might differ in some respect, it's almost impossible to use the stock market to do that. If I want to know what mood is like, say, in a geographic region within a country, hey, what's it like in the Pacific Northwest versus New England, say, in the US, or different regions of Canada? We can't do that with the stock market. But that's why these other data series are so important to supplement the message that the market is giving us, because you can look at economic data in those different areas. You can look at economic data among different demographic groups. You can look at social media sentiment from people tweeting from the Pacific Northwest versus the Northeast and this kind of thing. And so we use the stock market, but we don't use it exclusively. And these other data series are vital for giving us a more complete picture of what's going on.
That's wonderful, Matt. And there's this question, which this is one of my favorite questions when it comes to socionomics. How can socionomics work to improve society, not just improve individual opportunities at making money in investments? And I think it's a great question, and it's a very important one. And I think the answer is pretty clear to me anyway. And I'll use the COVID-19 pandemic as an excellent kind of foil for this. So as a social mood theorist, when we're looking at pandemics, we would say that, an overly optimistic, happy, carefree society is going to have blind spots, and will be more susceptible to pandemics than a populace that is, really scared and nervous and paranoid. So what happened in a lot of countries as social mood reached this kind of peak? Well, we actually saw funding getting stripped away from pandemic task forces. We saw research funds diverted away from the study of pandemics. We've seen PPE stockpiles, dwindle and not be replenished, right? So if you wanted to help society as a whole, and you were aware of this extreme in social mood that was approaching, and you were working in policy or an advisory role, that is definitely knowledge that you could have used to kind of benefit all of us. Of course, the greater question is, would anyone have listened? And that's perhaps a topic for a different day. But that's a question that I personally love to get, and it comes up fairly often in discussions like these. Do you have any thoughts on that, Matt?
I do, and that was a beautiful way of answering the question, Emery. That's so important. And it speaks to the importance of sharing this knowledge so that even if there is some inertia at the broadest level of society, there's a chance for uptake maybe among your community or among your family, where if you're socionomically informed, you can strategize at the community level or in your own business to, say, keep your employees able to be employed and working because you're prepared, say, for an economic downswing. So you're not scrambling to catch up when something like that happens. You have a plan in place. And that's why we're so excited to share this perspective, particularly at the university level. There are a couple of universities in the US who are on the leading edge of adopting this perspective and getting it into the curriculum, getting it into the classroom. And we heard from some of those students during the pandemic who wrote back and said, thank goodness I got introduced to this perspective, because I at least have a roadmap for understanding where we are and why we're seeing the trends unfold. So yes, it's still a rather chaotic time when you're in the middle of it. But if you've got that roadmap and that psychological perspective, it helps you to manage those feelings of anxiety so you can see the world more clearly and make decisions.
That's excellent, Matt. So we're running a little bit tight on time. We've gotten a lot of questions. Unfortunately, we won't be able to get to all of the remaining ones. However, there are a couple important questions here, I think, for both of us to answer. Number one is, how can folks get in contact with us if they so choose? And for those of the members in the audience that are new to this field of study, how can they, where can they go to get more information on this? So I'll just go for myself for contact information. You can find me on LinkedIn. I'm happy to chat, answer any questions you might have. I posted on LinkedIn in the past about, I would say the sister discipline of socionomics, which is the Elliott wave principle. So I posted some thoughts on how I look at financial markets and what I'm forecasting and so on. But I'm happy to chat about pretty much anything as it relates to this. So best place to find me would be on LinkedIn.
Terrific. And for me, we're a little old fashioned, I guess. The best way to get in touch with me is by email. You can reach me at institute@socionomics.net. That's institute@socionomics.net. And for the person who just wants to take the next step and say, hey, I've seen this, what should I watch next? If you go to socionomics.net/papers, maybe Ben could pop that in the chat, socionomics.net/papers. One of the videos on there is called History's Hidden Engine. It's about an hour long. It's a documentary that goes through in more detail even more ways that social mood regulates the trends that we see in broader society. It's a great next step.
Excellent. All right, so in the chat, we should have linked, so we have socionomics.net. Ben, I got a request to link my LinkedIn profile here. I put that in as a direct message to one of our coordinators. All right, fantastic. Thank you everyone for being able to join us. On behalf of U of T of Mississauga, thank you, Matt, for your presentation and to the responses to the questions from our audience. To our audience, like I said, we received a ton of questions today and we apologize if we were not able to get to yours in time. When this webinar ends, you will have the option to take a post-event survey, and we do hope you will take just a couple of minutes to complete it, as your feedback is extremely helpful for planning future events. Everyone who registered for today's event will also receive a link to a recording of this webinar in their inboxes over the coming days. And if you enjoyed today's webinar, be sure to check out the upcoming Snyder Series lecture featuring celebrated author Robin Wall Kimmerer, entitled Restoration and Reciprocity. You'll see a link for more information pop up in the chat box shortly. Thank you so much once again for joining us, and we look forward to hosting you again at another U of T Mississauga Alumni Online event.